I'm heading up to wine country, and on my way up there I decided to stop in Napa, California and do a little neighborhood walk for you guys over here. I'm right across the street from Fuller Park, which is a big park they have around here. And funny enough, for people that have never been to wine country, you always hear how Napa Valley has all the most prestigious wines and all of this and that. You always think like, oh, you know, once you get to Napa, it's going to be nothing but wineries, right? But in fact, Napa is actually just a regular old small town here in California with high price tags, which you guys will probably see. I saw at least one house for sale when I was checking out this area. So, and it's not cheap, guys. Like, it seems like no matter where you are here in California, houses go for crazy price tags unless you go to less than desirable areas probably. But anyhow, I figured we'll take a walk around here, see what the neighborhood's like, and we can talk about some of the forced selling trends that we're already starting to see happening right now, okay? And thank you, Steve, for sending me this story. And the first forced seller that is coming to the market right now in 2023 are people that are remote workers that bought homes that are not close to their job and are getting called back to the office. And I've covered different situations like this several times on how this could easily happen to people. And you had a lot of people thinking, oh, no way, I'll just quit before I move back there. I'll just rent the house out and become a landlord. Well, turns out that that's not really working out right now. In fact, 10% of home sales right now that are happening today are because of forced sellers that are involved with remote work, guys. 10%. Now that might not sound like a lot, but that's a pretty big chunk of today's sellers that are being forced to sell. And that's just the beginning. We're only at the beginning stages of this whole economic disaster that we're walking into right now. So Redfin basically did a survey, and they found out 10% of the people that are going to be looking to move in the next year are doing so because of their remote work job and the return to the office policy that their company has implemented. And here's actually the craziest part of all. A lot of these people now are going to have to sell at a loss compared to what they bought the house for. They talked to this real estate agent out of Boise, Idaho. That was a big pandemic boom town where a lot of people moved to because of remote work. They could get away from California, buy a house for half the price of what it costs here, whatever. But she was telling Redfin how she has clients that purchased their house about a year ago at the peak of the housing market, and they have to move back to Seattle for work now. She has this client where both the husband and wife work for the same company and have to be in the office 3 days a week or they'll lose their job. So it's probably Microsoft or Amazon if I had to guess. So they have 6 months to make the move. They'll probably have to take a $100,000 loss on their home. Now that's probably just the purchase price. We're not even talking about the loss in commissions, closing costs, anything like that. So it's probably going to be closer to $170,000 when you add all that up. And I told people on this channel many times in the past that we were probably going to see something like this happen in the near future. And lo and behold, here we go. We're starting to see it happen right now, where people are literally taking losses in order to move back to work for a job. Here we have a listing that literally just sold a couple of weeks ago, and according to Redfin's estimate, it's only worth $837 grand, but somebody actually paid $880,000 for this place. And this is what happens when you have one flipper selling to the next flipper. Somebody paid $655,000 for this house back in 2021, turned around, flipped it to somebody else just now for $880,000. And the worst part is, look what it does to the property taxes. Back in 2021, they used to be $1,229 a year. Fast forward to 2022, it's over $8,000 a year and climbing. I wonder what people like this are going to do when they actually move back to Seattle, for example. Are they going to buy another house because they're giving up their low rate? Everybody says that nobody's going to give up their 3% interest rates, but yet we're seeing specific examples now of where people are doing it because they need to keep their job, and they probably are not going to be able to find a better paying or similar paying job in Boise, Idaho, so they're choosing to give up that 3% mortgage and actually take the loss on the house. My question is, are people who are in this position, are they actually going to buy another house after going through all of this, or are they going to become renters? The logical thing to do, especially with all this turmoil, would be to rent for a while until you figure out your life and see what you're going to do next, because you just had this huge snafu with buying a house a year ago that you're selling for a loss and getting called back to the office. So if all that happened within the span of a year, what's going to happen next is what I'd be asking myself. Now, besides people selling right now just because of remote work, the actual #1 reason, according to Redfin's survey of why people are moving, is for more space. Other reasons are to be closer to family, to have a lower cost of living, and to get a better deal on a home. These are the main motivating factors that are pushing people to move right now. And coincidentally, I found another story today talking about why other people are buying and selling real estate right now, despite the crazy real estate environment with the interest rates where they're at and the prices as well. Because all you ever hear, the people who think real estate's never going to go down, is that nobody who has these 3% rates are ever going to sell, guys. Well, we just debunked that. That's definitely not true. And you're likely to see more and more people in a forced selling situation as the economy gets worse. But what about people who are not in a forced selling situation that are doing it anyways right now? And you're calling these people life happens movers. And it's funny because I made a whole video about this a while ago, and I think throughout that whole video I just named a ton of different reasons why someone would sell right now that have nothing to do with home prices or interest rates or anything like that. Here's the most classic cliche and typical reason: you have a baby on the way. There's this couple in Texas that were living in a small 1,300 square foot house. They had 2 kids already, and then they found out the wife was pregnant and said, you know what, we need to move because obviously this house is gonna be way too small to have another baby. So in June this year, they bought another house. They just doubled their interest rate and doubled their house payment along the way, and now they have the baby coming. So hopefully they can afford it. It doesn't say how much they're paying now and how much they were paying previously, but paying double is a big deal no matter what, unless you have a high enough income to not feel the impacts from that. That couple literally sold a home that had a low interest rate and bought another one with a higher interest rate, likely at a higher price as well. And there you go. There's one example. A couple of the other major ones that real estate agents are seeing right now are divorce, death, retirement. Those are all big life milestones that happen with people that can easily force a sale. And those are all reasons I had in my video from back in the day as well of why someone would sell. There's another real estate agent here talking about one of their recent clients was an estate sale. They had a parent that died. The kid inherited the house and they wanted to sell the house. They didn't want the house, they just wanted the money, which, by the way, that's what people do 70% of the time, according to previous stats that we looked at. And here's the thing, even if you want to keep a house that you inherited, sometimes you can't afford to and you need to sell it anyways, because if you're not going to move into the house or you're not going to turn it into a rental, you might very well not be able to afford to actually keep that house. They talked to another real estate agent over in Jacksonville, Florida, and she said that she has different clients right now that are moving also for remote work because they moved to Florida, guys, and now they're getting called back to the office, have to be back to the office at least 3 days a week, and bang, need to sell the house. Because one thing that a lot of people don't understand with this is this whole narrative before of like, oh, well, we'll just turn it into a rental. Like, it's so easy to just do that. It's not, guys. If you've ever been a landlord, being a landlord is tough. It's a business, okay? It's not like you just rent the house out and be done with it and you never have anything to deal with, okay? I've seen so many different problems that come up with properties. Doesn't matter if it's a condo, townhouse, duplex, whatever you have, single family home, there's maintenance that needs to be done. There's things that break, there's things that need to be maintained. Somebody needs to be there to do it. And if it's not going to be you, you're going to have to at least hire a property manager to deal with those things. And that's going to take an extra chunk out of your profit. And even if you don't have to deal with any of the stressful stuff and you have a property manager, you still are the head decision maker. They still are going to call you if there's any repairs that need to be done over a certain amount that need to be authorized by you. So you're still going to have somewhat of the headache. And if there's enough repairs and there's enough expenses throughout the year, then you might not even make any money on the property. Sometimes you might just break even. And it really just depends on the spread between the rent and your monthly on the property, and how much margin you have in there is if you're actually going to come out ahead. Because one thing I bet a lot of people weren't thinking about when they bought that house for remote work is does this property pencil out to be an actual investment property? Can I rent this out for a profit? I'm sure 90% of people who bought weren't thinking about that. But in reality, it just wasn't very smart for a lot of these people that got the go ahead to remote work for a while to just go and move across the country and, you know, buy a house, guys. That really wasn't the smartest decision on their part. And believe me, they're going to be paying for it now. And this just kind of teaches the lesson that I'm always trying to teach on this channel, is that if you're going to buy, especially in this environment, you need to just be cautious. You need to just run the numbers, guys. You need to buy something that you know you can afford, first of all. You need to buy something that if you needed to rent it out in case of an emergency like this, hello, then you can actually turn it into a rental property without losing money every month. But the problem is almost everything, especially if you're going to purchase it with a mortgage right now, doesn't really make sense to buy if you want it to pencil out as an investment property. Are there going to be situations and properties that do? Yes, but are they going to be few and far between? Absolutely. Because with these rates and these prices, it's almost impossible to actually make a profit when you're going to rent the place out. So usually the only way now today to actually make a profit is if you were to pay cash for that property, which 90% of people cannot do. Now, another reason I believe we're going to see more distress in the housing market and in the economy in general right now, because the Fed has put themselves in a position of basically being between a rock and a hard place right now, because they started raising interest rates last year, okay, and now we're at the between 5.25, 5.5% federal funds rate at the moment. They have a meeting next week, and they got to decide, are we going to do another interest rate hike, or are we just going to leave things where they're at? And what's the problem? Oh, right, that little thing, inflation, is going back up again. So we have 2 months in a row now of seeing the inflation numbers tick higher. So that is not good news for them. That's not what they want to see. And you can rest assured this is going to influence their decision of whether or not to raise rates again at the next meeting. And so basically by the end of this year, the Fed is going to have to make a crucial decision about the economy, of whether or not they're going to let the economy tumble or they're going to let inflation run hot, because they're not going to be able to do both, guys. They're not going to be able to solve the inflation problem without completely crushing the economy. And this is something that I have covered here numerous times on the channel, but it's something that people just don't want to hear, because you hear all these different scenarios from the media saying, oh, there's going to be a soft landing, or there's going to be no landing. We're going to hit this Goldilocks zone of, you know, the interest rates coming down stable enough and slow enough and having no recession, guys. That is a huge fantasy, and that's not going to happen. You know, we had the inflation numbers in July come in at, I think, at 3.2%. Well, now the August numbers are out. It's at 3.7%, guys, heading back to 4% in the opposite direction that they want them to go. And of course, we know that rents and the housing market is having a huge impact on this as well. And that's one of the main drivers of this, but it's not like that's the only thing. We're all paying more for gas, we're all paying more for food, we're all paying more for electricity and the water bill, every other thing that we need to run our daily lives right now. I love when you see the new price sign on the real estate sign. Yeah, we really are helping you get into this house. New price, $2.65 million. Old price, $2.85 million. We reduced it $200K, so now magically you can afford it. Come on in. Buy this Napa pool home today for only $2.65 million, guys. Now it's going to be interesting to see what the Fed actually decides, if they're actually going to crush the economy or they're going to let inflation run higher and hotter than they anticipated. Because if you don't know, their goal has been to get it down to 2%, but now it's heading back to 4%, possibly higher by the next reading. And so if they continue raising interest rates, then the consensus is they'll probably cause a massive recession, which I think is already going to happen anyways, even if they don't continue raising interest rates. But of course, the higher the rates go, then probably just the faster it will happen. That's my guess. You know, if they keep going with the rate hikes, then we'll probably just hit a massive recession much quicker than if they just keep it where it's at right now. But the problem is, all the stock market guys, all the betting of what the Fed's going to do next is all based on the Fed cutting rates at the beginning of next year, guys. Well, we already know that that's not going to happen now that we're seeing inflation go back up. You're not going to see the Fed starting to cut rates in March or anything. Right now, the betting markets are anticipating about a 37.8% chance that interest rates could be higher in June of 2024 than they are today. So at least that's probably on their radar, but I don't think it's what the majority of these guys think is actually going to happen. And so the problem is, I think if they're faced with this decision, that they probably won't let the economy crash. They'll probably just accept higher inflation, but as a result, that's going to cause more cost of living problems for everybody, guys, because look at what we're all facing right now when it comes to everything I just said: the cost of homes, the cost of food, cost of gas, cost of rent, cost of utilities. It all adds up. If that keeps rising at a faster rate than people's wages as it is right now, that is going to spell disaster in the future. So all they're doing by not crushing the economy today is just kicking the can down the road for its eventual collapse, because it will collapse when wages are not keeping up with inflation. And we know that one of the biggest hurdles and obstacles right now for anybody completing a real estate transaction is interest rates, okay? Interest rates combined with prices where they are is a big problem for transacting real estate because it just makes the payments unaffordable, okay? Well, there's a new startup company out there. They think that they can still get people 3% mortgages right now. And before you think I'm going crazy, hear me out. What they're trying to do is they are trying to set up a company that facilitates assumable mortgages for people. The name of the company is called Roam, R-O-A-M, and they just launched on Wednesday. So they're a brand new company. What they're trying to do is help buyers and sellers with getting assumable loans. Now, basically what that is it means you have a seller out there that wants to sell and they have maybe a 3% interest rate. Well, a buyer today can no longer obtain that 3% interest rate, and so what they're trying to do is bridge the gap, basically deal with all the red tape that's involved with making a purchase like that possible, where the buyer is able to assume the seller's loan. Now, in most cases, that's just simply not possible. If you have a standard conventional loan, you don't have an assumable loan. But if you have an FHA loan or a VA loan, those can be assumable, probably USDA as well, the government-backed loan, basically the government-sponsored loan. So Roam, the company, they estimate that about 22% of active mortgages are part of government programs that have assumption features. So that's a decent chunk of the market, I guess you could say. But the thing is, not a lot of people are actually taking advantage of these, and FHA so far this year has processed 3,349 assumptions, and that's up from last year of 2,566. So the problem is, Roam thinks that most people just are unaware of these loan assumptions, and they're trying to step in and make it easier for people to do them, which I think could be a valuable service for people that really want to take advantage of this. But the problem with it is a couple of things. Number one, they're only starting off in Georgia, Arizona, Colorado, Texas, and Florida, and all these places are pretty expensive already, as most of you know. And the other problem is, if you're going to buy a property that has an assumable loan, there's a high probability you're going to overpay for that property, because the seller is going to want to sell you that property at a premium for being able to get that lower interest rate. So you're going to pay more for the property on a purchase price than you probably would a comparable house nearby, and the only thing you get in return is that 3% interest rate. So if you're somebody who's looking to take advantage of something like this, you better be 100% sure you're going to be hanging on to that house for the long term, because if not, it definitely ain't going to be worth paying extra. Otherwise, you're going to end up like these remote work people that bought the house and in 1 year are regretting it or need to sell for whatever reason, and you just paid all this extra money for nothing. So basically, the founder of this company is saying, hey, have you ever called someone every day until you got what you wanted? Well, that's pretty much the kind of service that we do, because obviously it's a pain in the ass to facilitate one of these loan assumptions, essentially, with all the paperwork and red tape that needs to be completed. But these transactions can be complicated. So if you take a $500,000 house, which would be probably a pretty average price for most of these states that they're doing these assumable loans in, this is kind of how this would work out, guys. if they get an assumable mortgage with a $300,000 balance, say that's what the current owner owes on the property, then they still need 200 grand to close on that place. So Rome will facilitate that and help the buyer get in touch with additional lenders to get a second mortgage on the property. Of course, they collect a fee from the buyer that's equal to 1% of the purchase price as well. So not only are you going to probably pay more for the property, you're also going to pay Rome the 1% fee to facilitate your transaction and get all this done. And you're going to have 2 mortgages, not just one. So is it really worth it to go through all of these hoops and loops to get a property like that? That's what I think is the big barrier and the big deal killer with all of this. Say, for example, you get that $300,000 mortgage at the 3% rate, but now you still have a $200,000 mortgage at the 7% rate. There's a high probability that that $200,000 mortgage is actually going to cost you more per month than the $300,000 one, just because of the interest rate. And that's the biggest issue I see with this. So I think the guy that started this is clever in trying to find like a niche in the real estate business and try to help some more deals go through right now and grab a piece of that pie. But honestly, guys, I think once you do the math on all of this, that it's really not going to work out in a way that makes any sort of financial sense, because having 2 mortgages, paying somebody else 1% to facilitate the transaction on top of all of it is probably going to cost more than if you just got a really good deal on the house at today's rates, okay? And it also breaks the fundamental rule that I always tell people and preach on my channel, which is that you can always change your interest rate, but you can never change the purchase price. So if you are somebody that goes for a deal like this, you're essentially breaking that rule, because you're committing to paying more for the property than you should in exchange for a lower interest rate. So the interest rate can be changed, like I said, but you'll never change that purchase price. So always remember that, and remember that your property taxes are assessed based on your purchase price. Your insurance is also related to the value and purchase price of your home as well. Those expenses will be higher for somebody that decides it's a good idea to pay more for the property than for somebody who doesn't. So that's another thing to consider as well. But when it comes time to sell, for whatever reason, if you get involved with one of these transactions and the market starts heading down, you're going to be the first one most likely to be underwater and not be able to sell because you paid too much for the property, versus somebody that sat, waited, looked for the right deal, maybe got an off-market deal, you know, maybe bought an estate sale from somebody, house needs a full renovation, something like that, and got a property $50,000 to $100,000 under market value with a 7% rate and has immediate equity because they waited for the right deal. So just a heads up, if you're out there considering these type of things, I want everybody to understand more or less what they're up against if you come across one of these opportunities. So if you enjoyed this video, make sure you subscribe to the channel. And if you don't want to wait for my next one to come out, check out this video on the screen right over here, and I'll see you in the next one.